Hello guys, and welcome to the first video in our new series, which is going to be taking you through the process of how you can start backtesting and implementing systems into your trading. It's going to be a very accessible, very easy, very light-hearted series, which is going to be using entirely free data. And we're going to be taking very simple trading strategies based off indicators or price action movement, and we're going to be testing them with free data, and we're going to be showing you how you can introduce systems into your trading. At LikeAnalgo, we trade entirely systematically. However, we think that people often shy away from backtesting because they think it's too difficult, they don't know the data is available, or they think they need to be proficient in coding. And whilst this is true in the latter stages, it really isn't true when you're just getting started. So let's just jump in straight away. This is going to be Aussie dollar, and we're going to just be looking at a morning breakout. This is a fairly well-known strategy. It's going to take the 12 to 4 range, and it's going to say if once after 4 a.m. in the morning, if price has broken higher, then does price continue to move away from the range? Conversely, if price breaks lower, does it continue to move away from the range on the downside? So let's go over to TradingView. First of all, fire up a new Excel sheet. Just get some prelim data in there. Dates. So it'll be 24th June 21. Time and side, which would be long, short, and then we can record maximum, favourable excursion, and adverse excursion based on however we want to trade it. So go over to TradingView. TradingView only gives us data dating back to March. However, it's enough to get started. You can always use other free data sources like the one which we discuss in our free PDF. So let's mark out the 12 to 4 range. Just get a box or some lines. This is the low and this is the high, and you can see we're going to break out at 7:30. So what I'm going to do is I'm going to speed up the screen and go through the process of just getting all of these boxes marked up, because this is the most boring part. However, before I do that, let's just analyze the last 3 days. So here you can see price is broken out at 7:30, which is right in between the London Open and London Cash Open. Drew down by 5-6 points. You've got a lovely swing here. It's a very obvious swing with 2 higher highs either side of it, and it creates a kind of liquidity barrier and liquidity pool. Price moved away by 6.5 points, drew down by 6 points, so there isn't 1R there based on spreads of 0.6. However, that is interesting. And then you can see price actually came straight down, took the liquidity, and then swiftly moved higher. So what happened here? Breakout. Okay, around the same time between London Open and Cash Open. Price also moved 6.6 points away from the range. Had another inside day, an inside bar here. Okay, respected this swing low, but it did take a while to get 1R. Previous day, a lovely breakout. Look how clean this is. A clear high, trades lower all morning, and then comes up, tests the range here, gets rejected. So people are probably thinking, okay, this isn't going to work to the upside. And as always, if everybody's thinking the same thing, often in trading the opposite happens. So we get an initial, wow, okay, so we get an initial 10-point move away from the range, and the break bar is 7.8 points. Drew down by 4.2 before moving swiftly higher. Okay, so look, our thesis is that once price breaks, it's going to move away from the range, and then all we're doing is we're creating trading parameters to see which method's going to be best of capturing it. So where we're going to put our stop and where are we going to put our target. So let me speed up the screen and go through this process. back. We've done about a month. So we're just going to quickly jump in now and actually start analysing some of this data, because otherwise it's going to take too long for this video. So let's go back to the last day. Okay, so we've got our date and time of breaks now. Now we need to decide what's going to be the best way to trade it. So as I said, you can do it in a number of ways. You could use break bar, you could use a swing, you could use a retest, you could drop down to a lower time frame, you could say only take the trade. This is something that I've done in one of my strategies. Only take the trade when the liquidity pool, which is going to be here, actually gets tagged, and then once all of these stops get liquidated, you can take a trade, and you can take a trade with a stop below the low and a target at the high. These trades, they look really good and they really make sense. However, they're very few and far between. And often, sometimes it can be a little bit ambiguous as to where the liquidity pool actually is. So here you can see this would be a 4.4R, and it actually goes on to trade up to 9R. However, they are few and far between. So here, for instance, it wasn't tagged. Here it wasn't tagged. Here it was tagged. So you can see the swing high, the area where the two surrounding candles are actually lower, would be here at 75.218. So this level got tagged and closed within here. Take a short position, stop at the high, targeting the lows, 3.7R. This candle here actually traded just above, so you will need not only the level plus your spread, which would be, this is 3.1, if we assume a spread of 0.6, it would be 3.7. You would then need a buffer as well, because this can happen, because it's quite a popular strategy to do this. The idea being that people will just trade this strategy here and put their stop here, and when there's loads of stops accumulated, the market is very likely going to go and take them out. So that's one strategy you can use. It's a bit more complicated though. For simplicity, we are going to be imposing a fixed stop strategy. So what does this mean? This means once a breakout has occurred, we're just going to trade it with a fixed stop. So let's say 7.5 points. Let's say 10 points. So here we would be trading, we would have our stop here. Also, for simplicity, we're going to be assuming zero spreads. However, we cannot stress enough the importance of actually taking into account spreads. A lot of traders don't do this. So here, for instance, if we had a 10-point stop, we'd have a stop here. Now, optically, it doesn't look like, based on mid prices, that you'd get stopped out. However, you definitely would get stopped out, because this is 0.3 maximum. And I think average Aussie dollar spread is 0.6. So you'd have to either trade that with 10 plus your spread, so 10.6. Or you'd have to say, if you're using a 10-point stop, you'd have to say if it trades within 9.4 points, you'd get stopped out. So that's something to bear in mind. For now, we're just going to test fixed stops. So let's put a fixed stops. So let's put stop 10. One of the benefits of doing this is you can calculate maximum favourable excursion very easily, because when you know you've got a fixed stop, so your stop is going to be here, you can calculate the amount price has moved in your favour before that level has been hit. So this is 9.7. We're just going to assume the level isn't hit, because we're assuming 0 spreads, so midpoint trading. So the maximum favorable excursion here would be 20.5 points. So here we'd put 20.5, put the time of the breakout 7:30 and the side long. Okay, so that's going to be the process. I'm going to whiz it through again and do this for all of the days that we've marked up. So we've now got all of the MFEs and all of the stops. So what can we do now? How are we going to get out of the trade? So there can be a number of ways you can do this. You can either use a recent swing. So let's say here, for example, you'd use a recent swing here. However, that would only net you a small amount. And here you would use a swing down here. However, the price didn't actually reach far down enough to actually tag that, so that would have been a loser. And as you can see, generally from my experience, using swings isn't too good. Now, what are some other things you could do? You could use a moving average, like this, for instance. So you could say once it touches the moving average, you get out of your trade, which would be what, here. So that would be a 2R. I tend to prefer using a close beyond the moving average, which would be here, a 16.2, just because it can keep you in the trade for much longer. So here, for instance, you wouldn't get out here, you'd get out down here. Now, that's only one criteria. Something which I find quite useful and something which you could take into your own trading, although I have to say I don't actually use moving averages at all, is having a layered criteria on the moving average. So what do I mean by this? I'd say either stop me out when the trade gets to 2 or 3R, or if price trades back within the moving average. So here, for instance, you could see price traded down 55, so 5.5R, so you would have got your 3R on the 17th. So let's just quickly mark this, 3R. Here you would here you would have been taken out for a small loss, so minus 0.8. Sorry, that should be the 18th. That should be the 21st, actually. What do I do? Here we go. On the 22nd, yep, a loss, just a straight up loser, -1. On the 23rd, you would have collected your 3R. If you'd closed within, you would only have got 1.6R, so a much better outcome there. On the 24th, it looks like a loser, just a straight up loser, yeah. And on the 25th, yeah, a loser too. And then, so you can do this for all days, and then you can calculate your total R like that. Before you do any of that, you should probably calculate your maximum R. So what we have here is maximum favourable excursion and the stop. So to calculate a maximum R achievable, you would just do maximum favourable excursion divided by stop. And you can see we get some pretty big numbers here. Some trades even printed 9R, 7.8, and this is within a 24-hour period. A very simple way to do some backtesting and see if there's any edge there would be to simply impose a fixed target. So we've now got a fixed stop, and we could also impose a fixed target. So let's say we want a 1R target. We could then use some Excel formula. And guys, Excel is so easy. Don't be scared about Excel. You can Google anything, reach out to me if you've got any questions. It's super easy. It's actually much easier on a PC. I'm using a Mac, which makes it a bit tricky, but nevertheless, it's super easy. So here, all we want to know for a 1R calculation is the maximum R greater or equal to 1? If it is, equal 1. If it's not, it'll be a loser. And that's as simple as that. And we can draw that down for all of the days. And as you can see, the vast majority of days actually printed a 1R. Now, bearing in mind, we don't actually have spreads incorporated here. However, scanning down this list, this column, you can see that the closest, so the most questionable trade would be 1.18. We also had a 1.2. So if this was like 1.1 or 1.05, you have to consider the fact that you haven't incorporated spreads, which means that you're probably going to get stopped out if you're trading it. However, if, for instance, it printed 2R, then your target would have been hit. So you wouldn't have missed your target based on the spread. So we can also do this for 2R, 3R. So let's do it for 2 and 3. Drop that down. And let's calculate the total return over the last month for the strategy. So assuming a 1R target and a 10-point stop, you would have achieved a staggering 12R. Now, I honestly didn't expect it to be this high, considering I literally just pulled out a random 10-point stop. This is actually pretty insane, considering how simple the strategy is. If you were to trade it with 2% risk per trade, you'd get 24% return. And at no point did you draw down greater than 2, which means your drawdown would have been 4%. Now, the FTMO requirements are 10% monthly return with a 10% drawdown. So you would have blown that out of the park. However, this is also very interesting data. We just discussed that a lot of these trades actually move away by a large amount, 6.5, 6.4, 9. However, when you push for a larger target, your returns reduce enormously. You would only have achieved 3R, not 12R. Admittedly, if you went for an even larger target, a 3R target, you would have achieved 6R. But that's still only half. So sometimes it's not about maximizing the move. And I think this is what a lot of people get wrong. You can play within the 30-yard marks, and you can still make very decent returns, often actually more than if you were pushing for a larger target. To put this into perspective, our most profitable strategy to date is a strategy which trades multiple times a day, and it actually has a maximum return less than 1R, so it can never make more than 1R on a trade. So you have to think about that. Anyway, I think that's going to do it for today. I hope you've been able to get some value from this video. It's the first one that I've done. I'm happy to do more. If you want to continue this back test and send me the results, please do. You can find me on Twitter, or you can comment below. And as always, like and comment, please, if you like the video. It would help me out enormously, and it's not too much to ask from you guys. And yeah, I'll see you in the next one.